All right. This video is going to be about the price action, like how the price action um, formations and how the price and volume behave when a stock is moving higher, when it's in an uptrend, and how those characteristics change when the stock is topping out or it's turning down. So let's get into it. So I'm looking at AR, Interior Resources Corporation. So I'll move fairly quickly through this part. So this is your March 2020, the COVID thing. So after that, market started to rally, right? So the stock made this bottom, came up, and once it gets going, right? So you can see how the price action. So I have three moving averages on this chart. So this one is 200-day, this is a 50-day, and this is a 21 EMA. So the 50-day and 200-day are simple moving averages, and the 21 is the exponential moving averages, and these three are the most common moving averages which are used by a vast majority of traders, professionals and individuals alike. Um, some people look at other moving averages as well. Swing traders also look at 8 EMA, 5 EMA, even because they're short-term traders. So when a stock is in an uptrend, so what you want to see is so this is where the signs started to come. So the stock was coming down, and then it the 50-day moving averages started to turn up, right? And then the 21 started to turn up. So ideally, you want to see the 200-day, 50-day, and 21 EMA in an uptrend for a few months. So, as Mark Minervini has suggested, that he ideally likes to, before he buys a stock, he ideally likes to see the stock already in an uptrend for um, 2 months, 3 months, ideally 5 months, and sometimes even for 1 year. So before he buys that stock. Um, so different people use different methodologies. So I'll not go too much into the buying and selling of the stock, but there are certain characteristics, there are certain formations, how the price behaves when a stock is moving up and when a stock is coming down. So once it starts, climbing up, so ideally you want to see big volume on up days, and the rest of the area is you want to see either quiet or lower volume, especially on down days. And another thing would be more up days, 1, 2, 3, and less down days. So you're seeing 4 up days, then a couple of days down, 4 up days, then a couple of days down. And in here, so this was a gap up, so it was kind of extended from the 21 EMA and from its original base as well. So then you saw multiple days, 1, 2, 3, 4, 5, 6 in a row, and price kind of retraced quite a bit, 17%. So, and then you're looking still, you were here. So you see, so it comes down and stops right at the 21 EMA. This price action wasn't concerning because the volume never rose. The volume was quiet. If this was breaking down on a bigger volume, so similarly here, so if it was breaking down on a bigger volume, that would be a concern. So um, and one of the other key things to note is when a stock is moving up, so it will go up rapidly and then wedge down slowly. That is the key thing I want to discuss here. So it will, move up abruptly, then drift down slowly, then move up quickly, then drift down slowly. And your moving averages, all of them, 200-day, 50-day, 21 EM, they should be, in an uptrend. They should be pointing upwards. So as the stocks advance, kind of um, gets too extended and the things are about to turn around, you will see some of these features, the price action. So your moving averages will start to flatten out. um, Whether it's 50-day, 21, the 21 will start first because it's more sensitive, and it's the exponential moving average, so it reacts quickly compared to 50-day and the 200-day, and then slowly your 200-day moving average will start to flatten out, so it's not in an uptrend anymore. But up to that point, um, you you just don't want to jump out of the stock as long as the price is still moving up, and the stock is still able to make new highs. There's not a ton of volume on the down days, but your first signals of trouble would appear when your stock starts to break down through the 50-day moving averages. So anytime if your stock's coming down a big percentage. So these are the key points to note. If your stock's coming down through the 50-day moving averages on heavy volume, so this I can't call a heavy volume. We'll know when we see that. So the moving averages are still, in an uptrend and stocks moving nicely. So there's another point to note down. Generally, when a stock breaks out of its base, so it comes down twice at least to 50-day moving averages, and it's safe to buy the stock or add to your position only the first two times when it comes out of its properly formed base. So third time, if the markets are strong, if the general averages like SPY and the Nasdaq are still in an uptrend, and there's a lot of buying going on, so a stock may be able to push through, third, or sometimes even, in a raging bull market, fourth time. But you don't want to add to your position, or don't even try to buy the stock when it's that obvious to everyone. So it came down, touched down on the 50-day, comes back on comes back above the 50-day and 21 EMA on big volume, and then it keeps going. But as uh, there are two more factors to consider as well. So generally, there's a there's a saying that when a stock has been advancing for 18 months, so you want to count from its last base where the stock gets going, all the way up to, wherever you currently are. So it doesn't exactly have to be, but in most of the cases, you will see that stock will start to move sideways. It's not making new highs anymore. The second thing is the base counting. So you want to look at the number of bases. So this is a weekly chart. So um, let's say let's forget about this one. So number one, number two, kind of number three. So base on base. So this is number four. You don't want to buy the stock when it's coming out of its third stage, or don't even try in fourth stage. So those later stage bases will most likely fail. So 18 months later stage bases and the moving averages start to, kind of rollover. So the stock was climbing for quite some time. So let's say it actually started climbing in October 2020, and so in here, October 2021, that's 12 months, and then you know so yeah, somewhere in March, April, your 18-month mark is crossed. So it's only a month or two afterwards that the stock started to falter, and this is another sign when you see a large volume, but the price, the stock wasn't able to move, above the 50-day moving average. So at this point, we're still seeing, this picture, your 200 days still uh, in an uptrend. But the 21 EMA has, crossed below the 50-day moving average, and your 50-day moving average is rolling over. So um, then again, so it comes down, quite a bit, and and these are the signs. So this one and this one especially, when a stock comes through the 50-day moving average on a big volume, and then it's not able to take the 50-day moving average within few days. So that's a concerning part. So then again, it starts to rally up, and it's not able to go all the way up and take that high out. So that's always a concerning thing. So it comes down, even goes above the moving average, and the moving average is not able to lift its head. So it's just still rolled over. Once again, it tries to go up, but it comes down on slightly higher volume, and then again it tries to go up, then again breaks down on heavy volume once again. So it comes down on heavy volume through the 50-day moving averages. So this is where I like to put the stock on my watch list. So because once this starts happening, then I start thinking about shorting a stock. So I would have sold it, anywhere closer to fourth stage formation. So or the first sign of trouble. So we are not talking about holding the stock anymore. So we are past that. So once stock starts to break down, you want to see at least 3 attempts to go up. So it comes down, it makes first attempt, fails to make new high, comes down, and then fails to make a new high. And one of the key things in the bearish price action is this rounding off of the price action. So this is what I call a wedging action. So the price comes down, what in a matter of 3 to 4 days, and then it takes, it kind of takes forever the price to rally back up to that point. So it takes 66 days so to recover a break of 3 days. So that tells you that the whole picture is a change, right? And then again, it decisively closes below the 200-day moving averages. And this is again, once the stock breaks below the 200-day moving average, so it will one last time it will try to kind of rally back to 200-day moving average and try to take that moving average. But once you have seen these 3 attempts, so the picture is already very clear that what's happening and where the stock is headed. So sometimes it may come back all the way, or sometimes even go above the 200-day moving average. But that's by no means a buy signal. So it's still you're still looking for shorting the stock. So So it breaks down and then rallies back into the moving average. That's where you short it. And then once you have taken your short position, so you want to write it down with the 21 EMA, and you probably want to keep your stop somewhere behind this 50-day moving average. So the stock is basically doing the same thing. You see how the prices were, kind of up, staying above the 50-day and 21 EMA for most of the time, and the price was wedging against, coming all the way up to 21 EMA, then rallying back, wedging lower towards the 21 EMA or 50 DMA, and then kind of gets going. In the distribution part, when the stock is coming down and when you short the stock, so you just want to see the exact opposite picture. So a stock will drift down, it will go back, rally back into the moving averages, whether it be 21 EMA or 50 DMA, and then start to roll over. So then again, so this is the kind of a picture perfect scenario you want to see when you're shorting the stock. So the 200-day moving average is rolled over 50-day, and so is the 21 EMA. All the moving averages are rolled over, and they are in a clear downtrend, and they are stacked exactly opposite what was happening when stock was climbing. So your 50-day was above your 200-day moving average, and your 21 EMA was above the 50-day moving averages. And now the opposite thing is happening. Your 50 days below the 200 day moving average, and your 21 EM is below the 50-day moving average. And these moving averages are also pointing, downwards. So this is just an ideal scenario. All the stocks do not behave like this. This is just one scenario, but this wedging price action, this living below the moving averages and moving averages rolled over and higher volume on down days, these are the common characteristics when stocks start to come down, and these are the common characteristics what I look for when I'm looking to short a stock. So it just one final note, in this one I actually shorted this one. Yeah, I took my full position at somewhere in here when third time, it failed to make a new high. So I shorted it somewhere around 37 area because of this rounding off wedging action. And then I think I added some at 34, 32. Then in here I covered 1/3 of my position. So once it came back here, I added more to it. So it's coming down nicely. And I still have, although the market's really turning up and the number of new highs are improving every day, but because this individual stock has its own bear market, so I'm holding a full position, and um, I'm expecting it to come down somewhere here to uh, so yeah, the nearest support area is at 20 or so. So then I'll cover at least half of those. So this is these are the key features. So you want to look in when whether you are trying to long the stock or short the stock.